All right, welcome everyone. We look forward to spending the next hour with you as we discuss navigating a successful divestiture. I'm Michelle Gross-Core, Managing Director out of our Chicago office. Before I introduce my colleagues and we dive into our topic today, I'd like to walk through a few key reminders. All of our Riveron webcasts are housed on our website. We have some great past webcasts and look forward to some upcoming great ones as well. There will be 4 polling questions which must be answered to obtain CPE credit. If you have any questions throughout this presentation, feel free to ask in the Q&A option in the bottom of your Zoom window. Webinar evaluation form and CPE certificate will be emailed to you. The on-demand video is not eligible for CPE credit, unfortunately. You will receive a follow-up email including the following: access to this webinar recording and the deck, the ability to join our webinar mailing list to receive future invites, and our presenter contact information. All right, now for the presenters today. We have Josh Beer, Managing Director out of our Chicago office, Ryan Gamble, Managing Director out of our Chicago office, Sasha Morozova, Managing Director out of our Atlanta office, and Adrian Sawchuk, Managing Director out of our Atlanta office. For our agenda today, Adrian's going to kick us off and talk through the M&A outlook. Strategy and deal execution will be led by Josh. Carve out financial statements, Sasha will take us through that. And then Adrian will end our day today with separation activities, and we'll get into some questions and answers to the extent we have some time at the end. All right, now polling question number 1. Does your current, near, or midterm strategy include executing a divestiture of a portion of your business? A, yes, B, potentially, C, no, or D, prefer not to disclose. All right, now while we wait for answers to roll in here, Adrian, as you kick us off here, I do have a question for you. In the past, have you seen strategies affected in the near or midterm by changes in the environment?
Thanks, Michelle. Yes, that's a great question, and I certainly have. I mean, if you take a look at it back in 2001 and 2008, and we'll talk a little bit more about those later, I certainly see a change in strategies, not only in the volume, but also in the nature of the deals, the size, and the targets. You know, post 9/11 and the dot-com bomb, there was really a strong shift. If you remember, the deal evaluation metric that was used was eyeballs. And certainly after that implosion, we certainly went to more conventional evaluation methods. So, but I think it's a different time right now. We'll see a chart later on that takes a look at the premiums that have been paid in the last 12 months for deals. And they're definitely much more tempered. Although I think we'll experience some of the similar patterns from prior downturns, I think this one's going to be a little bit different.
Yeah, I look forward to diving into that more. All right, now as we see our results here, it looks like no, that the strategy has really not been impacted. So Adrian, looking forward to hearing more on the M&A outlook.
Great, thanks, Michelle. So what's interesting, if you take a look at the last 2 downturns I mentioned, 2001 and the Lehman Brothers financial crisis in 2008, there was a significant decrease in deal volume by about 30 to 50%, with a recovery period to get back to pre-crisis volumes of anywhere in the range of 18 to 24 months. So that's a pretty substantial decrease and a relatively long ramp back up. I think the current situation is somewhat different, though. If we take a look at the stock market, right, there's certainly a strong rebound to date. So we think the recovery could be faster than we've seen before. On the other hand, there's some uncertainty about the duration of the pandemic, the vaccines, and concerns about wave 2 occurring. Anecdotally, we have seen deals that were on hold start to move forward again. So overall, it does seem like the rebound is happening a little bit more quickly. Another thing that's really different, that's really different from prior downturns is the amount of dry powder that's owned by private equity type investment vehicles. So we're at $1.4 trillion that's currently held by investment funds. And that's the highest in history, really. So while in pre-2007, many PE firms had undertaken very sizable deals and were highly leveraged, and in the intermediate aftermath of that crisis, they moved more into protection mode. While there would be casualties in certain sectors, retail, energy, hospitality, travel, overall, the PE industry is much better positioned than in 2008. What's interesting too is holding periods are longer right now, and deal volumes have been completed at lower prices. So the multiples have reduced, and we're seeing better overall returns. We've had some underperforming tech unicorns clearly, and that may have dulled some of the appetite for public offerings, such as Uber or Lyft, and it may move more towards alternative investment structures like PE firms. We mentioned some of the larger deals, and in the last year, there's certainly been some big ones. The United Technology Raytheon combination, $135 billion in value, the $36 billion Aon Watts Towers merger, the ThyssenKrupp acquisition by a private equity consortium, and then Intuit's acquisition of Credit Karma, all large multi-billion dollar deals. But what's interesting is the premiums have been fairly modest on these. And whether we continue to see large deals like this going forward or smaller deals more focused on divestiture is certainly an open question. On one hand, it seems smaller deals will be more prevalent given the uncertainty and the factors to potentially increase liquidity and focus on core assets. But on the other hand, there are some large companies that may need to do some significant cost reduction, and so that may drive some larger deals as well. So while it's hard to predict how the second half of 2020 is going to look like, I think the large amount of dry powder and reasonable premiums to date will drive an acceleration in the recovery that's probably going to be more rapid than we've seen in prior downturns. Given the level of distress experienced by some companies and industries, we would expect M&A to be used to improve balance sheets as well as diversify sales, change the customer mix, and even diversify the supply chain if you take a look at manufacturing locations or warehousing locations. Importantly, while M&A activity is always risky and often fails to deliver on the objectives of the transaction, increased uncertainty in this time may further increase that risk, underscoring the importance of proper strategy, diligence, planning, and execution of those deals. And we'll be talking about some of those things that you always need to keep in mind, but even more so at this time when there is more uncertainty on long-term cash flow and EBITDA and market valuations.
All right, thanks, Adrian. Very insightful. Now we've got polling question number 2. How have the prevailing macroeconomic conditions impacted your company's deal appetite? A, delayed or renegotiated deals in progress. B, extended due diligence on existing deals. C, pause in active pursuits to preserve liquidity. D, no impact. Or E, prefer not to disclose. Now, Adrian, as we wait for everyone's responses to roll in here, I'm just curious, what industries do you expect to see a quicker recovery in the M&A activity in the near term?
That's really kind of pretty fascinating to really sort of think about it as you look at different industries and consider the impact on industry recovery and profitability, which is one thing, and that doesn't necessarily correlate with the increase in M&A activity in that industry. If you look at those industries that have been dramatically impacted, F&B, hospitality, travel, there's certainly a lot of uncertainty on the rebound timelines. So that may extend the time before deal flow starts to pick up in those industries. On the other hand, industries with more near-term certainty that haven't been that impacted, distribution, logistics, manufacturing, to name a few, may be the ones that show the first waves of M&A activity, and then it will be followed by those industries that are more impacted.
Yeah, makes sense. All right, now we've got some results here. Seems like varied across the board, but majority looks like no impact. So it's interesting that, you know, the conditions we're living in hopefully will not impact us going forward, or at least have minimal impact. All right, now I'm going to hand it over to Josh to talk through our strategy and deal execution.
Thanks, Michelle, and thank you everyone for joining us today. The current economic environment is presenting new challenges for businesses, as Adrian highlighted, across industries, and it's potentially exposed cracks in portfolios. It's also been an opportunity for management to examine their assets and operations in more detail, particularly given shutdowns and maybe some time at home for some reflection. We've listed here 4 reasons we think that carve-outs are going to be a tool that companies will continue to explore as they navigate the tumultuous times ahead. So first, we've got companies may renew their focus on their core business. Times of uncertainty have a way of underlining or highlighting the most critical portions of a company's mission and business. So shedding assets that don't adhere with what a company envisions as their future state can free up capital to invest back in the core business, allowing for a stronger rebound out of the economic trough. Second, maybe this economic environment has exposed weaknesses. I think that's the case for a lot of companies. You know, so maybe a specific division is underperforming due to COVID and the related impacts. Might that division be best under different ownership? Could you free up capital to reinvest in the rest of the business? These are questions that we think management needs to ask themselves in order to be good stewards of their business. Third, the current climate may cause management to find that they need to sell a division in order to keep the rest of the business afloat. Certainly not the type of thing that management likes to see as an option, but this type of distress sale might be a useful tool to fall back on if necessary. And finally, management may simply determine that the sum of the parts of their business are greater than the whole together. Continually assessing your portfolio from an outsider's perspective is important, because if you're not doing that analysis, it's likely that someone else will, particularly if you're public, which could lead to shareholder activism as opposed to taking your own strategic initiatives. So as we'll talk about in a second, whatever the reasons you pursue a carve-out, the path towards executing a successful divestiture requires that you have that clear vision and your strategic intent and rationale. It'll dictate your approach and how you execute the deal, how you approach the stand-up of the new company, and ultimately separation. So what do you care about most? Value or speed? In a distress situation, you may need to define your transaction perimeter in a way that facilitates speed, but may not generate the most value. Obviously, value is going to be important, but if you have a liquidity concern, you're going to value that speed. Maybe you focus on a single plant that is not integrated and won't have substantial carve-out or people-related carve-out implications, and which will allow you to move more quickly to achieve your desired outcome. Are there unique stakeholder interests, a unique owner situation driving the liquidity event that may dictate the assets identified for disposal? Employee considerations, so other stakeholders, employees that determine how you want to structure it. Is there a country that's going to require additional approvals for the employees to be divested? Is that going to cause a delay, and therefore you may want to exclude that from your scope? A desire to not disturb the ongoing core business. What timing is, what will timing of your divestiture be impacted by if you're while you're running your business, and how do you want to minimize that? Can you afford to slow down the deal in order to allow the organization to wear multiple hats. These are all things you want to consider. Market conditions. Are valuations in your industry impacted by COVID, and does that matter for your deal thesis? If so, what are your sensitivities around it, and how can you potentially mitigate through structuring? All of these things are things we're going to want to consider as we move towards the planning and execution of actually divesting a business. So actually going through the execution of the divestiture is often much more challenging than expected. The tight timelines create internal constraints, but once you've got your strategy aligned and prior to going to market, you'll need to prepare. So first, define your transaction perimeter. Understand what is in and out of scope. If there is any kind of ambiguity, it's usually best to cast a wider net than necessary, as it'll allow for some flexibility for changes down the line. I worked on a deal a few years ago where my client initially included 4 divisions in scope. Ultimately, they opted to only go to 3 divisions, but they were able to make that change after doing their diligence and getting the appropriate market feedback from potential buyers. And they were allowed to make a more informed decision after the fact. So next, once you've defined your transaction scope, you'll want to prepare for your buyer diligence. It's often very, very time consuming. And you'll want to identify value drivers and potential deal issues well in advance of going to market so that you have time to highlight key value in the business or mitigate issues as necessary. Part of that is performing multi-workstream diligence, financial, IT, tax, operational, HR. All of that enables early identification of potential issues and helps you gain impactful insights on what the business's performance is, allows you to market it more effectively, and prevents value leakage. It'll also help you figure out what the Carbot requirements actually completing this are. Carbot requirements around financials, people, processes, systems, data. All of those things are things you're going to need to think about and can be uncovered through buyer diligence. You want to proactively think through what the audit and regulatory requirements might be based on buyers and other deal factors. What kind of financial information are you going to want to provide to prospective buyers? At a minimum, you'll want to present deal-based financial statements so that buyers understand the value of what they're buying. You may want to prepare a standalone analysis to assess the cost of running a division or an asset when separated from your organization. If you plan to provide buyers with a sell-side quality of earnings report, you should also start that process as early as possible. You should prepare a data room that's ready to house all significant contracts, descriptions of IT workflows, key employee information, and other operating workflows and metrics. All this will prepare you for the onslaught of buyer questions once you're in the market and your time is in extremely great demand. So that's preparing yourself to go to market. A couple other things that will be negotiated with the buyer down the line and are often thought of a little bit later, but transaction service agreements and purchase price mechanisms drive a great amount of value. It's good to think about those early in the process and take a position on what you're willing to offer as the seller. Clearly establishing what the TSA looks like and how it will be measured, who will pay for what the length of time you'll be under TSA is. It's often an overlooked value driver to the overall deal. Along similar lines, establishing the proper benchmarks and mechanics for how you're going to handle working capital, purchase price mechanisms, as well as purchase agreement reps and warranties. Handling those up front can mitigate value leakage during the contracting process. The last thing I'd like to mention is that as a remaining parent organization, it's important to analyze your own cost structure with a lens towards operating without assets that you're divesting. Identifying stranded costs will help you operate in the most efficient manner possible once you've actually divested the asset. One final thing you'll want to consider in more depth is ways you can mitigate value loss from a tax perspective. And for that, I'll turn it over to Ryan Gamble, who leads our tax practice, to discuss.
Thank you, Josh, and hello, everyone. As Josh mentioned, one of the key strategies to divestiture is unlocking or creating value inherent in the organization. However, there are a number of factors that can serve to reduce or erode that value, taxes being one of them. And in fact, the lack of tax planning during the execution process of a divestiture is often cited as one of the primary culprits to a reduction or unexpected erosion of value as part of the deal. And we see that erosion taking place in three areas primarily: lack of planning around the sell side diligence, as Josh pointed out, lack of proper planning around structuring, tax structuring particularly, and then also in the kind of post-deal transition environment. In sell side transactions, we're often brought in after buyer's diligence has taken place and the buyer's diligence process has identified a significant or material tax issue. And at that point in the process, it's really too late to do anything to mitigate that. You're often spending your time trying to change the buyer's mind as to the relative amount or the limit of that exposure, which is often set at the highest possible potential exposure amount. And just one example, recently we were brought in on a sell side after buyer's diligence had gone through their process and then covered a multi-million-dollar sales and use tax exposure. And we were relegated at that point to just trying to defend the value of that liability. However, had the company engaged in a sell side process around taxes earlier in the execution of the deal, they may have been able to even mitigate that issue going into advance by reaching out to the state taxing authorities, or at a minimum, come up with a appropriate calculation of the exposure, defended that, and been in position to not give us so much away in the value aspect of it. And as a result, in this particular deal, there was a significant reduction in purchase price. As a result, there was an increase in the escrow amount, and the value that they thought that they were going to get out of the deal was significantly impacted around one tax issue. On the other side of that, there may be opportunities, if carefully analyzed in advance, to actually unlock value. For example, the CARES Act recently passed had a number of tax provisions in it that permitted companies to take advantage of net operating loss carrybacks that had been restricted in the past, additional deductions, things of that nature. And once the divestiture takes place and that company is sold, it's often very difficult, if not impossible, because of the way the operating provisions of the purchase agreement work, or the transition services agreement, in terms of getting the proper approvals, the authority to file amended returns, to go back and try to monetize existing tax attributes in the process. So careful analysis of not only the risk in advance, but also potential opportunities that may be limited going forward, or two ways in which to potentially protect or prevent the erosion of value through the sell side process. We also see value erosion taxes taking place through the structuring. Buyers and sellers are generally have opposing viewpoints or objectives when it comes to a structure. Buyers are typically looking for an asset deal for the tax benefits associated with that, whereas a seller is often considering an equity deal because of, again, the potential tax impact. Having a thorough view and an analysis of what each of those transactions might mean to the seller, and then going through a process to build flexibility into the structure, taking transaction restructuring steps to build in flexibility so that as the deal moves forward and objectives may change or negotiations take place, being able to make changes to the structure in a way that's not overly detrimental to the seller is, I think, a vital step that every company should be considering, in a pre-deal environment. And then finally, in a post-transaction scenario, having an understanding of what the change to the seller's tax profile or tax footprint might mean and also the impact on the buyer is a critical process that should take place. Oftentimes, the seller is divesting of a business that may be underperforming and may have had losses historically, and those losses were being utilized to shelter or shield income tax and other aspects of our business units of the business. And when that is gone, you've created value through the divestiture, but then you're surprised with an increase in your tax liability. So understanding that, taking steps to mitigate that pre-transaction is a critical step that we think most companies should take. And then also on the buyer side, they're acquiring a change into their tax footprint as well, and understanding the impact of the change for, say, state tax exposure, state tax nexus, the impact on the tax function as a whole, having understanding in the transition services agreement of who's going to be responsible for the continued compliance of the old business and the new business going forward, and understanding the cost of that, as Josh mentioned, is extremely important, so that companies aren't surprised by the lack of understanding of who is taking care of what, being surprised by penalties and interest that may accrue as a result of failure to comply and failure of understanding of the responsibility of the parties per the agreement. So taking steps through the sell side process, taking steps to carefully analyze the structure, understanding the responsibilities and roles of the parties post-deal and the impact to the company's state tax profile are important steps that the company should be taking and taking early on in the process to help prevent the erosion of value as a result of taxes, and in some cases even maybe unlock and create value that may have been missed if not carefully considered prior to the deal close. So with that, Michelle, I think that takes us to our third polling question.
Great, thanks Ryan, and thank you Josh. That's all great information to consider. Yeah, so polling question number 3. Which alternative investment structures has your company considered to preserve growth momentum while conserving capital? A, special purpose entities, B, carve out, C, joint venture, D, licensing arrangements, E, none, or F, prefer not to disclose. Now, Josh, as we wait for these results to roll through here, question for you. Have you seen, or where have you seen, the most issues or trip ups in the process?
Yeah, thanks, Michelle. Each deal is different, so I wouldn't say there is one primary culprit. Something that I think does have a tendency to be overlooked is the human side of things. So communicating early and often with your people, making sure that employees who will be transferring to new ownership are engaged and invested in the process goes a long way. If that doesn't happen, they can also really derail a process. So it's important and healthy for employees to see that a buyer is going to be new ownership that's really investing in their business and therefore their vision. So outside of just the financial impacts of defining who's in and out of scope and whatnot, really making sure that you communicate with your employees, I think is extremely important. Making sure that they're on board with everything in your strategy. So now let's take a look at those answers.
It makes complete sense. Yes, let's go to the answers. All right, it looks like majority have said none and prefer not to disclose, but joint venture and carve out, interesting. And, we've seen, both of those in the past, so that makes sense. All right, now on to Sasha for carve out financial statements.
Thanks, Michelle. Hi, everyone. So the first step in preparing carve out financial statements is to understand why those carve out financials are required. And before we dive in further, I want to clarify that I refer to audited US GAAP or IFRS historical financial statements and not the deal financial statements, which are prepared as part of the due diligence process. One scenario where carve-out financial statements can be needed is when a buyer is a public company and the business it is acquiring meets the significant test of SEC Rule 305. When the parent company has not yet identified the buyer, but it is possible that the potential buyer can be a publicly traded company, preparing carve-out financial statements with Rule 305 requirements in mind can be a good idea to avoid adding any future rework or additional disclosures down the road. If the carve-out entity is considered to be significant under Rule 305, you will need at least 1 or 2 years of audited financial statements. The number of years you will need depend on the significance threshold. While we're on significance topic, I also would like to highlight that SEC recently issued a new guidelines on the significance test, which reduced the number of years required and also changed the computation of income and investment tests. So be on the lookout for that if you are in a 305 situation. Carve-out financial statements can also be required in a spin-off situation. In that case, the financial statements of the new spun-off entity must be included in an SEC registration statement. Carve-out financials can also be required in an IPO or 144A private debt offering transactions. The number of years usually required in those situations is 2 years, but for marketing purposes, or if the carve-out entity does not meet the status of emerging growth company in an IPO, 3 years may be required, and with up to 5 years of selected financial data. If there is no public company involved and there is no SEC rules that need to be met, carve-out financial statements may still strongly be requested by the acquirer or their lenders. And since carve-out financials take significant time to prepare and more importantly, get audited, we recommend that if there is a possibility that they are required, this process is started sooner than later. Now, the ultimate goal of the carve-out basis financial statement is to present the historical financial results of the business as if it was a standalone company, including all costs of doing business. There's actually very little authoritative guidance for preparing carve-out financial statements, and as a result, there's a lot of judgment involved in their preparation. Carve-out is different in the complexity and execution. Each carve-out is different. From the macro level perspective, the most important factor to determine is what legal entities are being carved out. If this is just a segment of existing business with no commingled locations, the data extraction aspect will be a lot simpler. Carve-out becomes increasingly more complex if it involves international locations with partial legal entities or segments, as it creates additional complexities in extracting the data and also can pose language and cultural barriers. When it comes to accounting specific consideration, the first thing that needs to happen is for everyone to agree on what the perimeter of the carve-out look like, what is the basis of presentation. It is probably the most critical step in the process for everyone to agree, including auditors, management, due diligence team, and potential buyer. Any subsequent changes could result in significant work and potentially could impede desired timeline for completing the transaction. When deciding which assets and liabilities should be allocated to the carve-out, it is important to evaluate all commingled assets and liabilities which are shared by the carve-out entity and the parent. It is not appropriate to just simply allocate a portion of a particular asset or liability to the carve-out entity. Instead, you will need to determine whether full attrition or exclusion of commingled assets and liabilities will be necessary. But even if a specific asset or liability is excluded from the balance sheet, the carve-out entity should recognize an appropriate allocation of the expense related to this business. For example, if there's a manufacturing facility that jointly used by the parent and the divested business, and parent retains the asset, the appropriate amount of expense should still be allocated to the divested business. Corporate overhead is usually one of the most judgmental areas as well. With the idea that carve-out financial statements need to include both direct and indirect expenses, indirect corporate overhead has to be analyzed and determined which drivers need to be used to appropriately allocate the cost. This has historically been a big area of focus for the auditors. As it relates to taxes, the carve-out entity must prepare provision as if it were a separate standalone entity. The topic of net parent investment is usually one of the topics where auditors are asking a lot of questions. Although essentially net parent investment is a plug, it is important to understand how this balance is generated. Net parent investment represents the difference between income statement allocations and balance sheet attributions, unless an arrangement between the parent and the carve-out entity requires cash settlement. Intercompany transactions is another area where complexities exist. To proper account for intercompany transactions, it is important to determine whether intercompany payable or receivable will be settled. It is not uncommon for the parent to forgive amounts owned by the subsidiary. In this instance, the forgiven amount would be accounted for as equity contribution. On the other hand, balances that are expected to be settled on cash would be reflected as due to from parent entity. And lastly, in terms of materiality, management will need to separately assess materiality for the carve-out financial statements. Errors that were immaterial to the parent can often become material and can result in a restatement in the carve-out situation. And now I just wanted to spend a little bit of time distinguishing between the two sets of financials. We have just covered accounting considerations that are important for the GAAP or IFRS carve-out financial statements. Those financials are subject to the audit and may be required as part of the purchase and sale agreement, or as I mentioned earlier, may be required for the SEC filing. On the other hand, deal-basis financial statements are used for marketing purposes. They're presented in confidential information memorandum or SIM. They're used in valuation and in management presentations. They include more forward-looking information and such adjustments as out-of-period costs, normalized versus actual results, and other non-GAAP adjustments. It is very important to be able to have a solid reconciliation or a bridge, if you will, between US GAAP carve-out financials and deal financials to be able to articulate the differences to those involved in the transaction. And that brings us to our next polling question. Michelle?
Thanks, Sasha. That was great. Polling question number 4. What have your challenges been in executing a divestiture? A, insufficient planning. B, poor synergy capture. C, change management. D, lack of communication. E, other, or F and A. Now, Ryan, as Sasha went through all that, I couldn't help but think through kind of from a tax perspective, any key challenges when preparing GAAP-based carve-out financial statements. So just curious of your perspective there.
Yeah, no, great question. I think oftentimes companies underestimate the amount of time it takes to prepare the separate return method provision that Sasha mentioned in her presentation. That requires a completely different and almost as expansive provision as the company prepares on its own. On a separate return basis, what changes is you have to look at that company, where it's operating, where it's doing business for state income tax purposes, sales and use tax purposes, and basically redo your nexus calculation and state tax liability. And you have to do that alongside the existing provision for the company that's not being carved out. And doing that provision twice is often a significant burden on the existing tax function within the company if they're using their internal tax department or on their advisors. So just taking into account the amount of hours that are required to prepare a separate standalone provision with new sets of facts is where we see people really struggling and falling behind the pace when trying to get carve-out financials through the system.
Great, thanks, Ryan. All right, now for our results. Looks like there's a mix, a little bit across the board, which is expected. I'm sure oftentimes there's a couple kind of challenges throughout a specific deal. So this makes sense to me. All right, thank you for responses there. And back to Adrian to talk through separation activities.
Thanks, Michelle. Based on that polling question, we'll address some of those potential issues around insufficient planning, synergy capture, communications in this next section. So there's really sort of 3 areas that we should take a look at and consider. One, we've talked a bit already about is how to maximize the deal value for both buyer and seller. identifying those sources of lost value and mitigating those risks, maximizing the deal value by managing costs and entanglements, and then establishing a PMO office with functional and cross-functional work streams. We'll talk a little bit more about 1 and 2 later on, but I did want to talk about the PMO office a little bit. Oftentimes, we think about that on the buyer side as part of the integration or the stand-up, but also having that function set up on the seller side is important, and Josh alluded to that previously. But there's a lot of work to be done, a lot of timing of that work, and a lot of communication, setting up the data room, etc. So there's a body of work that treating it through a PMO type function is certainly helpful. On the human capital side, taking a look at employee costs and liabilities, ensuring ongoing operations for the parent company, the transitioning entity, and then the go-forward entity are paramount. And then can't really emphasize enough that understanding the key talent and developing retention strategies for those and ensuring ongoing communication to those key internal stakeholders is paramount. And then other functional areas to take a look at: legal, commercial, finance, IT, supply chain operations, and we'll address those in another slide. So going a little bit deeper on some of the areas around value erosion and how to maximize value. Understanding the run rate costs of the parent company are really important, and Josh mentioned that. But post TSA roll off and termination, there's really an opportunity to take a look at the parent company's business, identify opportunities for process redesign, for right sizing, for optimizing the operating model, and to ensure that the cost structure is not one that was really intended for a large organization and now is serving a smaller one. Corporate allocations and services, replacement costs, those need to be considered as well. And separation costs, the one-time costs on both sides of the business, of the parent as well as the go-forward entity or the buyer, can be high. We've talked about a good amount of pre-work in terms of the seller diligence and prepping for that, and that certainly will serve to try to minimize those costs for both parties. And I guess it goes without saying, but being presenting that data and being responsive and sharing information and providing accurate costs or estimates on the go-forward entity are important, because that really provides more clarity and more certainty to the deal. And on the flip side of that, when you've got situations where the go-forward entity cost structure is grossly underestimated, or let's say there's an ERP stand-up situation and that has been underestimated, the seller is going to do their own diligence on that. And when they come back and they see that their estimates are significantly different than the buyer will do their own estimates. If those estimates are significantly different than what the seller is seeing, that certainly starts to raise a bit of a cloud of uncertainty around other topics as well. The TSA is important to really cost that out appropriately. Again, it needs to be fair for both parties. The seller needs to cover their costs and provide a service to the buyer for that time period. But again, the buyers are going to do their diligence and take a look at what is reasonable around those costs as well too. The other area that we haven't talked about so much is around both the customer and the supplier. So as we carve out part of the business from both sides, from customers and sales, as well as from suppliers in volume purchases, there may be some impact to unit price economics that need to be considered as well. If we take a look at a little bit more on the human resources side, there's four areas to really kind of consider. One are the costs and the liabilities. The standalone employee costs, the treatment of any equity grants, other financial obligations and concessions that are related to the transaction need to be thought through on both sides of the seller and the buyer. Financial obligations such as pensions, bonuses, PTO, all those need to be planned for and accounted for and modeled for the transaction. Maintaining business operations, regarding the TSA and the support required, it's important to be realistic around the support, the level of service, the additional stress and requirements that would be provided to the selling entity. It's important to have a solid labor relations strategy, particularly when we look at international deals and taking into consideration the various nuances in different countries and work council consultations that may be required. Establishing a plan for managing the retention, transfers, and redundancies of both sides, both the seller and the buyer, and then ensuring that we align the relevant functions post-transaction to account for the new volume of transactions that would be occurring. During the transition period, we need to make sure that that's smooth as possible. Understanding, again, the labor relations, any regulatory and legal requirements, having a good HR work plan to be really crisp around what the sequence of the key activities are and the interdependencies with other functions, and establishing a common approach to knowledge transfer and workforce transition to ensure that the processes and the understanding of how systems work is transitioned. And then finally, retention of talent. We talked about that previously, but it's really hard to emphasize that too much. Communication is critical, identifying the key employees and those that may be at risk from a retention perspective, and ensuring that appropriate incentives and potentially retention bonuses are considered and used and applied as needed. The last area that I want to talk about was some of the more functional areas around and considerations. We talked about the legal entity, but understanding what legal entity or legal entities are involved. This is particularly complex around different countries. Establishing a clear timeline and separation timeline, particularly if we're dealing with multiple countries and potentially multiple timelines for those entity transfers. And then synchronizing that legal entity separation and the required name changes. Those will have implications in other areas throughout the organization, particularly on the commercial and the supply chain side. Speaking of commercial, considering whether there would be any marketing or brand changes to the parent company, how to handle customer transitions, communicating with customers, what the impact will be to them, transition of those contracts, and ensuring that appropriate service levels are maintained throughout the transition, and the impacts on the sales and customer care organization, which of those will stay, which of those will go, and communicating that both internally as well as externally to your customers. On the finance side, post-divestiture, there'll certainly be a change to the operating model. There'll be an interim operating model which supports the TSA, and an end-state operating model which occurs post-TSA termination on the seller side. And then clearly on the buyer side, depending on whether it's a stand-up or an integration, there'll be a lot of work around designing and implementing the end state operating model, reviewing current processes and understanding the final state of the organizational structure, the skill sets, and the budget required for that. The IT side is also can be a fairly complex area. Understanding licensing requirements, ownership of proprietary systems, which of those stay with the parent company, which of those are used for the TSA period, and which, if any, go to the spin out entity. Access to this historical financial data is critical as well too, particularly if there's a different ERP that will be used in the go forward entity, and how that's going to be extracted and then accessed by the go forward entity. There's certainly physical assets on day one that need to be transferred, and then timelines for the managing any IT resources that would move over. If you take a look at the supply chain side, we mentioned a little bit on contracts, but there's certainly a supplier transition that needs to happen from contract validity to tactically how the purchase orders will be processed, and the names on those purchase orders. Sometimes some of the resources will move forward, particularly if they're embedded in locations. Which procurement, demand planning, logistic resources move, and which ones will retain, and how do you backfill for those that move? And on occasion, you've got actual physical resources that need to be divided or segregated, whether they're plants or warehouses or offices. And finally, we did talk about TSAs a bit. It's really important to not only understand the scope and the level and the service levels provided by those TSAs, but also think through the tactics of billing and receipts and payments and the escalation processes around those. So with that, I'll turn it back over to Michelle.
Thanks, Adrian. Almost seems like we could have a whole webinar just on TSAs.
That's a good idea.
All right, we've got a couple minutes left here for some questions, and we do have some that have come through. So first question to Sasha: how long does the preparation of the carve-out financial statements typically take?
Oh, thanks, Michelle. Yeah, that's a great question. Unfortunately, I don't have a straight answer. It's going to be 1 month, 2 months. It definitely depends on the size of a carve-out. But where we've seen, so at least it's going to be at least several months, right? Given that you need to get all the data, identify the perimeter, identify all the adjusting entries, and obviously get it audited. Where we've seen efficiencies can be gained is as you prepare the carve-out financial statements, is having a clear documentation, your starting point, all the carve-out adjustments, a clear walk, so it's very, very easy for the auditors to go behind and audit the transactions, and have a position papers on key judgmental areas, such as what is the corporate overhead allocations, what were the drivers used and why, the clear documentation of how you're handling corporate debt, whether you're pushing it down or not, intercompany transactions, how they're treated, will they be settled. If you have that clear documentation of the positions that you've taken, we've seen that you can shed off some of the audit timeline, which obviously is just like normal audit, depending on how easily the data is available for the audits. But the process takes at least several months. So we do recommend starting this process as soon as you know that the financials will be needed.
Great, thanks, Sasha. All right, now I've got a question for Josh. When should we think about performing a standalone analysis?
Good question. I think it's an important analysis to perform anytime a division is receiving a significant amount of support from a corporate shared service model. So cost could be significantly different, once separated from the parent. So it's critical to understand the impact that may have on value, just so you can best position your business for market, understand the value that you're delivering, and give buyers a clear sense and on level footing throughout an auction process. I think it's also particularly important in instances when you've got a private equity buyer as the counterparty. But I think it's it's still valuable regardless of the buyer. But in those instances, they will likely be standing up the whole organization and maybe will have a view of their own. And it's best if you position the business for market, with that in mind.
Great. Thanks, Josh. All right. One more question to Ryan. Where do you see companies struggle the most with tax as part of the divestiture process?
Yeah, good question. I think it's easily answered through kind of the audit process, and where we see companies receiving significant deficiencies as it relates to taxes is just the underappreciation for the additional amount of work on the entity that's acquiring the business and the impact that has, as I mentioned earlier, just on the overall footprint, and not really taking into consideration the amount of time and effort it takes to understand all of that and get that not only into the compliance process, but also part of the provision process. Often the team that's involved on the buyer side is already fully staffed, FTEs working on the existing historical business. And then the additional work that takes is sometimes a Herculean effort that takes additional resources, but it also taxes the existing team. And shortcuts can take place. And as a result, there are typically issues or deficiencies in the provision process and also in the compliance process, resulting in underreporting or failure to file penalties and interest. So having a good estimation of the additional hours are required to tackle the compliance provision process is where I think people struggle the most.
Got it. Thanks, Ryan. And thank you all for joining. We're just about up at the hour. Thank you for joining our conversation today. We really appreciate you spending the hour with us, and we look forward to you joining future webinars. Here are some additional resources that may be helpful for you in further thought leadership and just requests to speak with us. If you do have any further questions, our panelists and speakers today are absolutely happy to engage further and break down any further questions. Thank you again, and I hope you enjoy the rest of your day.